Well, the sun's coming up here in Hyattville, and I've got these funny looking cords coming out of my ears. I wanted to put together a video on the types of business organizations that's what we're going to talk about this week. There is a slideshow. You can look at that separately, but we're going to go through them as well through this video too, and you can take some notes. But you can always go back and just look at the slideshows if you want to review or anything like that. So I'm going to share my screen real quick here. Get the desktop. Okay. And then start this presentation. Now we've gone a long ways in this class, and hopefully it hasn't been too convoluted. But you know, we started out with building a mission statement. You know, and I'm gonna do a somewhat of a synopsis of the class for next week as well. But the whole progression of the thing is that a person builds their personal mission statement, and then from that builds their business mission statement. And you may have some stated objectives beneath there that actually state your mission, give you a little more direction and things like that, which we didn't work on too much, but that can be developed. And maybe this is a good time for you to go back and take a look at your personal mission statement and also your business mission statement if you have one. Okay? And then we went into a chapter on decision making. Okay? And those mission statements derive your decisions. And for the easy decisions, you know, I see people that just every little decision is so painful for them. And there's others that just take it for granted, and they make some really huge decisions, and they make them on the fly and all that kind of stuff. And sometimes it's, you know, it ends up on the right side of things, and other sides it's just a disaster. Remember, if it's a big decision, if it's going to affect your personal life, or if it's going to affect your whole business, then you need to take the time. Information is power. You need to take the time, assemble that stuff, get some professionals, get some experts, bounce it off your friends, brainstorm, that sort of thing. Big decisions require a lot of information. Small decisions shouldn't be painful. All you have to do is either you've got your mission statement hopefully memorized, and you go, you know, this is just a small decision. Do I go out and irrigate this morning? Well, I want to be the best crop farmer in the Bighorn Basin. It's a no-brainer. I get out there with my shovel and I start irrigating my crops. Okay, small decisions require very little time, and most of the time, if you've got common sense, they don't require. We don't spend any time on them. Okay. It's just like that's just a function of eating and breathing, is that we make those decisions. We go on. We make those kinds of decisions, 100 of them, you know, every single day. And but those big decisions get some information. Okay. All right. Let's talk about farm business organizations and their transfer, as it states here. And it's a really, really important part of it. I kind of saved it towards the last so that maybe it would stay within your heads when you're thinking about this thing beyond this class. But of course, you know, you can set up as a sole proprietorship, you can set up as a partnership, you can set up as a corporation, LLC. There's cooperatives out there. There's all kinds of different legal types of business setups, and they affect a lot of how you function as a business, and especially how those assets can be transferred. In agriculture, we think about the asset transfer from one generation to another a lot. So I mean, they can affect that a whole bunch. And you know, the media these days has has gotten on the bandwagon that it's, there's so much, you know, quote, evil corporate farming out there and things like that. Well, if you really you drill down in the data, 95% of farms and ranches are owned by families, still are. Okay. Now, if you're just looking at certain data, most of those farms and ranches have incorporated over time because of some tax benefits and some organizational benefits. So it does look as if, if you consider corporations evil, which they're not, but if you do and you want to make a big splash in the media, then yes, a lot of agricultural assets have been moved in or transferred into a business organization that's just, it's a benign thing that the IRS simply calls a corporation. Okay. Or some other LLCs are also very popular within our ranks. So there's still a lot of sole proprietorships out there, and it's one of the probably when startups are made, used time and time again. So they're easy and quick and all that kind of stuff. But let's get into that. Okay. Here's just an outline of what, and you can kind of go through that. What we're going to talk about throughout this chapter. I think it's really essential that we talk about a little bit, just a short little bit, the life cycle of business. It's and you may recognize if you come from a farm or ranch or any kind of business. I mean, agriculture, we kind of have a tendency to set ourselves aside. I enjoy studying businesses that have been successful, and also ag businesses or farms and ranches have been successful. I find if there's a successful farm or ranch, people have a tendency to treat it just like another business. I mean, you can still, it's still a lifestyle, it's still your passion, all those kinds of things, but everything about that thing that they call their farm or ranch is treated as a business. Okay? All right. So if you're going to jump into farming or ranching, in the next day or two or the next year or two or something like that, that would be the entry point. And that's generally, we have a passion for something. We're going to fix something. We're going to serve people. We're gonna do something, and that's the initial startup. And you can usually go back to it if it's already a business in place, or we can be brainstorming about that as we go forward and start it up. Okay. The second one is the growth phase, and this is something, usually if you start a business from scratch, you have absolutely no sales to, I have to start producing something and selling it to the public or the market. Okay, and this would certainly be a growth phase. There may be upticks in this growth phase. You may go through it several times within an agricultural business. As we bring on more people, we're going to have to grow. Maybe you're going to go back to the farm or ranch and you're going to have to grow, things like that. So you may go through this phase several times. So consolidation, that would come after the growth phase. For our particular business, we're in the consolidation phase of it. We grew really quickly. Well, not really quickly. It was over 25 years. But now we're just kind of holding tight with what we have. It's producing a nice income for our family, things like that. But we're not really considering the growth part of it. It doesn't mean that we can't go back into the growth phase again. But at this point in our life, our age and all that kind of stuff, we don't have too many heirs and the things like that We don't have anybody bringing into the business, so we're not considering that part of it. And then the exit. And that's one of the things is that, everybody has to exit. And those of us in agriculture sometimes have a hard time with this. I know I have some personal friends that have a ranch up in the northeast corner of the state that their mother, who is in her 90s, has promised the boys who are mid 60s that they will get all the cattle and all the machinery when she passes. But there's no plan for that transfer. And they're acting like it's going to happen, and it may happen if all the siblings, which there's about 8 of them, then there's 2 brothers that are running the ranch. But um, being honest with oneself, probably going to be a problem with transfer at some point when she does finally pass, because nothing's been written in a will or no way of doing it in a real, half of it might go to the state, and that's just a reality of it if we don't plan for something that is inevitable. I mean, all of us have to get out. I mean, life ends. That's just the way it is. Okay, all right. And businesses end. Business for us ends. And typically, here's a graph. Us economists, we got to throw it up there on some kind of chart and show you over time. This is what the size of the business, and generally on the exit we're headed downhill. It doesn't have to be that way, but if we transfer it, to other people. Let's talk about sole proprietorships. Okay, the owner owns and manages the business, assumes all the risks, and receives all the profits. Okay? I mean, as a couple, you can have a sole proprietorship, a married couple, or a couple. So it's real. That's how we started our business. I've started several businesses this way. It's just, today we're not in business. Tomorrow we are in business. We've started a sole proprietorship. It's in the name of Todd Jones. It's under my Social Security number. As far as business goes, the IRS, you report to the state, any of the agencies, that sort of thing. It's just a sole proprietorship. I take on all risk. I'm liable for all decisions, both legally and on the ground, and also I will benefit by all profits. There's no special legal permission required. I mean, unless you live in a town that has an ordinance that says you have to have a business license, you may have to do that. That's some of the really minor things that you might have to do. The advantages to it, of course, is that, today I'm not in business, tomorrow I am, and it's just that simple. It's just simple, and it's a real free way of being in business. You may just have an idea. I mean, with the internet, you can literally, with no money, start a business, and that wasn't the case for most of us that grew up in another age. The disadvantages is the personal liability, and we're from a lawsuit. If anybody slips and falls on your sidewalk, something happens that you're responsible for, you are legally can be sued, and all your personal assets can be attached to these lawsuits or things like that. It may limit the amount of size, and it has a lack of continuity. When we talk about continuity, that's where we get into the transfer. How do we, if it's in I am Todd Jones, the business, sole proprietorship. How do I move it to somebody else at some point? If it stays as a sole proprietorship, it's not that easy to transfer that ownership without actually setting down and doing something with it. Okay, size may be limited. I mean, I may not have the obvious one would be, I might not have the capital to grow the business. Another thing, I might not be smart enough or have the expertise or the training in order to grow the business. So it's got some disadvantages there. Okay, taxes on the profits, and this is a big one when you're dealing with the IRS and the state income tax. If you happen to live in a state with income tax, Wyoming, by the way, doesn't have any, as several other states don't. But is that the tax rate is your individual rate, and all that income comes onto your individual form when you file your taxes. Okay, so record keeping. Most of you have been in Mr. Finch's record keeping class. Becomes, as it is for any kind of business, essential, so that you can keep track of what's going in, what's coming out, inflows and outflows, as far as that goes. Okay, so that's kind of in a nutshell the sole proprietorship. A joint venture um, is it's just a short statement, and it can be set up, you know, an operating agreement between two individuals. And I mean, it's very flexible again, like the sole proprietorship, except you may get together. You may a joint venture example would be where, and I have this happen right now. We have about 100 acres of hay. Um, Most of the farming involved on that, because I don't want to own all the equipment that's necessary. I have a custom haying outfit, or my neighbor come in and put up that hay, and that'd be a joint venture between he and I. And in fact, we actually trade off how much he gets, a percentage of the hay in the joint venture, and that would be an example of a joint venture. Okay, I would recommend that these things actually be put down on paper so that there isn't any misunderstandings, because there is just a world of things. I know people say, well, I can't think of everything to put on paper, but you can think of the essential things. I know he's your neighbor and you like him and he's your friend and all that kind of stuff. And I do business with friends all the time, but those are the relationships that you don't want to damage. You don't want to hurt. So those are the ones that you really want to put things down on paper so that you don't step on each other. I mean, I've seen and I've been involved in some of that before, and it's not an easy thing. Maybe the rest of you can as well. Partnerships, corporations, limited liability companies, and cooperatives can be involved in these things as entities of themselves. We're going to talk about each one of these too, but I was just talking about two possibly sole proprietorships getting involved in that. And in fact, Nancy and my company is an LLC, and we have an agreement with our neighbor who is a sole proprietor with this custom haying. So, you can mix and match a joint venture. So, and they're real flexible. Just, usually you just have like a one-page type of an agreement, and it's down and dirty, and you can write it on a feed sack if you want to. As long as I really want to emphasize the fact that you should put this down on paper, this so there's a good understanding. Okay, that I mean, this is what we just income is shared in the same proportion as fixed assets and expenses are contributed. I mean, it's up to how you set up the agreement, though. Okay, I mean, like I told you before, we set it up, our custom hay agreement, so that he gets 25% of the hay. I do all the irrigating, fertilizing, and all that kind of stuff, and then he comes in with his equipment and he just hauls off his part of the hay. It's like I say, really down and dirty, and kind of an easy thing to do. Okay, you can go through that if you want to. Partnerships, I want to talk about um, in and really, this is probably a lot. When we recognize that we can't do everything, we have a tendency, and I've been involved in several partnerships, but have a tendency to say, let's make a partner, let a partnership as a business, because you bring this to the table and I bring this to the table. I mean, first warning is that if you have the same passion as your potential partner, or you have the same expertise as your partner, I would look at it really, really closely. I mean, how are you going to benefit each other? Where are your strengths? You should you should make the business better if you're going to get involved in this kind of organization by bringing yourself together. So you might have a, you know, I mean, just on the really simplistic way about it, and that's how I have a tendency to think of things. But you might have a guy that just loves to get up at 4 o'clock in the morning, get out there and irrigate. He just loves that. And then you have a guy that really, he's not a morning person at all. But this guy is unbelievable. He can fix anything. Okay, he's a mechanic, and electronics are just easy for him or her. Now, in a farming operation, that might be a great. They might taking people with different qualities and bring them together. It might be a great match for a business, and you might consider a partnership. Anyway, a partnership is an association of two or more persons who share ownership of a business. There's a couple different kinds, and you would write this down again. I mean, you can do it an oral partnership agreement. I would never do this. Okay, there's too much room for misunderstandings again, just as in the joint venture. Okay, a general partnership. Partners contribute to the management of the business and are exposed to unlimited liability, just like the sole proprietors, the general partners. You can have a mix of this second kind, general, and then the limited. Okay, limited partners do not participate in the management and are liable only for what they have contributed to the business. Generally, limited partners have some kind of equity stake in the business. Okay, it may not be, and they would only be liable for the amount that they have put into that business. Okay, the general partner is taking on all of the risk, and that's the big part about it. I mean, you may have a big capital backer that puts up all the money and you do all the work. You may be the general partner in that. You both potentially could be a general partner, and that'd be another, bringing two people that have different qualities. One guy's got the money, or one gal's got the money, and the other one does not, but has the energy, the passion, and wants to work. Okay, so you can do it that way. I've done it both ways. I've had an equal general partnership. I would warn you about them. Most partnerships don't work, and they end up most general partnerships end up in disaster because you just don't take care of how you're going to get out of it. You don't look at the end game and things like that, but we'll talk about that in a little bit. I currently, like I mentioned before, we have actually an LLC, and maybe I'll mention that before, but it acts kind of like I'm the general partnership. I actually have 90% of the shares, and my partners have 10%. Their equity, they act like limited partners. So in fact, when we were going through, what we wanted to do was grow the business. We needed some capital, they perform that function, and and they don't have anything to do with the management. They can participate, they can throw their ideas, but as a 90% stakeholder, I can veto or approve anything that I feel like, basically. But not that I say that flippantly, but that's how that's set up. And I I'm the one responsible for the business, have the hugest liability and things like that. If it were set up like a partnership, it isn't, and we'll discuss how LLC is set up here in a little bit. Okay, in a general partnerships, number one, the general partners share the business profits and losses. There is shared control of the property or assets with possible shared ownership of some of the property. Okay, shared management of the business. We may have several people, and that's, when you get different personalities within a business and people that want to go, you want to go this way, you want to push more towards farming rather than the livestock end of things. If you've got two different people and only a certain amount of capital, that may be contentious at times, and recognize that before you get into this kind of thing. So in general partners, if there's several of them, share the management of the business. Written partnership agreements, there's a lot of them. You can get them on the web. And there is no doubt that I would have a lawyer. Anything beyond a sole proprietorship, I would have a lawyer at least take a look at our agreement. Okay? I really would, especially when you're just getting into forming businesses. Number one thing that should be is who is responsible for which decisions and how shall they be made. That should be addressed within a partnership agreement. Number two, a list, and this needs to be, well documented. I mean, with the computers and things like that, you can take pictures, tag them. You put them in a spreadsheet with a web address with a picture of it, so there's no question of what you brought into business, what your partners brought into business. List the property each partner will contribute and how it will be owned. Okay, does it come in and it's owned by the company and will be under dissolution of the company? Will it be split? Blah blah blah. Will you get it back after it's used in the business? If it gets to that point where you need to dissolve the business, you need to address those kinds of questions within this document. How will the shares, profits and losses, and describe them carefully. I mean, you can split them however you want. It might be 50-50, it might be 60-40, 70-30, however you want to write it up, but have it very well addressed there. You need to designate who's going to be the record keeping, and there can only be one. But I mean, you might delegate off parts of it, but one person has to be at least responsible for the records within the business. Okay, and designate that. I mean, a typical partnership on most businesses will be a fairly large document. I'm talking, 10 pages or more. And like I say, there's some great examples out there that you can start out with. If you know a lawyer, a contract lawyer, they have some templates that will address each section of the business in order to make a good partnership. Again, I would kind of anyway, written partnership agreements, taxation should be addressed. Include a detailed account of tax basis of the property. So that's the valuation on a tax basis of property, and copies of the partnership information tax return. Termination, state the date of termination if it is known. Okay, this business, this general partnership, is going to last for the next 5 years and will be terminated on this date. if that is the case. Most of them, I mean, we don't even think about that too much. I mean, the next step of dissolution is if we, I mean, people's lives changes. I mean, I might get an opportunity to go and set up business in northern British Columbia. I'm sitting here in the Bighorn Basin in Wyoming, and I want out of my partnership. Have a way so that you can get out of it. How is that going to be dealt with? It's a lot easier to do it ahead of time within this contract than it is to go, how are we going to do this now? If there's nothing, there's no procedures that you have. How are you going to divide the property up? I mean, land is not that easy to divide up, and things like that. Termination, just to kind of give you a little deal on that, at a particular time is indicated in a written agreement. Upon the incapacitation, think about it. I mean, if I tip over tomorrow, how's it going to be dealt with? Those are really, really important things. Bankruptcy, if the business goes bankrupt, or what happens if one of your partners goes belly up in business on his own, has a personal bankruptcy, that's going to affect you too. That needs to be addressed within this agreement. Okay. The advantages of a partnership. Okay. Easier and cheaper to form than a corporation. It really doesn't take too much anymore to start a corporation. Probably $500 to $700, maybe max out $1,000 for a small corporation, kind of a simple corporation. But a partnership, generally, we were talking about $300 to $500 to set up and have a lawyer draw yourself up an agreement. Carefully written agreement can allow the partners to maintain much of their freedom. That you need to address that within the agreement. Flexible forms of business that can accommodate many different situations. It's a very flexible kind of thing, and really it doesn't take too long to set one up. We can be in business in a couple of days if we have the wherewithal to come bring a couple people together with their capital and property that benefit the business. So they're fairly simple. Disadvantages. Okay, and these are things to think about when we're talking about setting up these kinds of businesses. Is unlimited liability of each of the general partners. Now, I just talked about what's going to happen if your partner goes bankrupt. I had this happen. One of my partners, I had a general partnership in the beginning. It was among two other fellows besides myself, and one of them, he didn't declare bankruptcy, but he might as well have. Went through divorce. We were counting on all his time and energy and passion and things like that, helping the business out. Well, he had to go get a job because he had to support his family that was in another household now. So I mean, it wasn't anything that we could. It was beyond our control, and to be honest with you, we didn't deal with it within the partnership agreement. What happens? Okay, yeah, under those kind of situations, do all the properties revert to the partners that are working in the business, or anything like that? That could have been addressed way ahead of time. So, and in fact, I mean, at that point, depending on the character of the partners, I mean, if he'd have run off with the checkbook, we'd have been liable. If he'd have done something, stupid, we would have been liable. So kind of think of, be real careful who you choose for your partners. Any partner individually can act for the partnership in the legal and financial dealings, and the other partners will also be held responsible. That's why you've got to be very, very careful who you choose for partners. the character and integrity of those you involve in a partnership. And I mean, for anybody in business, really, I don't want to deal with anybody with without the highest integrity and character. But because of the liability issue, you need to make sure. So it's not something that you just kind of float a message out there on the internet and say, "Yeah, I'm looking for a general partnership. Any takers?" You probably get, as long as you got the money, or the big part of the property and assets, you probably get you'll get a lot of people sign on for that, but you may not know what their character and integrity are. Um, there is poor business continuity within this type of business, and you can probably see that just looking in. If you had an hourglass here and looking in at a partnership, you've got several personalities that have a percentage ownership within the business, um, and it may or may not be dealt with within the partnership agreement in the beginning. It can be amended so that you do deal with that. You might all of a sudden, I mean, you get along with your partner, he's a great person, or she is, and then all of a sudden he dies. His or her heirs get that part of the property or that part of the business, and then all of a sudden your partners are his crazy relatives. Do you see what I'm talking about here? It can be very, very difficult. So continuity of this thing, I mean, a successful business can be cratered within just a short while when you get, we just talked about integrity and character, but you inject some craziness in there too, or people that don't know what they're doing, and it can certainly be an anchor or push your business over the edge. So anyway. So those are the disadvantages. And in this day and age, I would probably encourage you, if it is, unless you're just kind of dipping your toe into the wading pool as far as the business goes, that you set your business up in another way than a partnership. But it's out there, so we got to talk about it. It's kind of like going into debt. We don't like debt, but sometimes we got to talk about it, because probably most of you are going to handle some kind of debt, and you may be hit by a relative or a friend or somebody out there that wants you to get into a partnership with them, and you need to know about it. A partnership does not directly pay taxes itself as the entity, as the business. If you have a farm that is a partnership, the partnership doesn't pay the taxes. You, as the partner, the individual, it's percentaged out. If it's 50-50, then 50% of the profits or losses go to, say if there's two partners, 50% go to each. So depending on the percentages, and again, that's the easy part of it. And then you're taxed at your rate. If you're at 15%, your partner's at 28%, then your tax rates are going to be different as far as that goes, and they'll show up on your individual return. So everybody's always concerned about that sort of thing. Now I'm going to stop here because this is too long of a video, and then we'll just call this part one. But we're going to talk about corporations next. Okay? So hope you enjoyed this. It wasn't too painful, and we'll start a new one